My name is Geneva Stegmuller. I'm with the Partners Group. I'd like to welcome everyone to our webinar today. I would really especially like to welcome Matt Drake. He's the director with FMI Capital Advisors, who will be leading today's webinar. Matt comes to us with over 10 years of experience working with companies and their shareholders. Due to the complexity of an effective transfer of ownership and leadership, we will be hosting 3 separate webinars, with the first focusing on equity transfer. Our speaker is with FMI Center of Strategic Leadership. They spend a significant amount of their time with senior leaders in seasons of transition. We also happen to have John Woolley on the call this morning. He's on mute. He's just there so that if there are any questions that come up that could possibly apply to his expertise, he's going to be available for any questions as well. John is our Managing Director of Wealth Management here with the Partners Group. We will be talking about equity transfers this morning, and if you're lucky enough to be on this side of the table that generates liquidity, that poses its own set of complications and opportunities. And John here with our wealth management team is an excellent resource to handle that high quality problem. And we may hear from him in coming webinars in this series. John will also be at our live event on January 22nd. So thanks, John, to be online with us. Just a couple of reminders. If you have any questions at the end of the webinar, a form's going to be popping up in which you can ask specific questions. In that form, we will ask questions like what specifically you need more details on or help with, when and how you would like to be contacted with additional information, the timeline in which you would like to be contacted. And we will also be emailing the questions and answers afterwards, along with a recording of this webinar as well. As I mentioned earlier, this is part 1 of 3 webinars. We will be hosting over the next 4 weeks, ending with a live event here in Portland at a local place called the Harvest Wine Bar. And that event will be on the 22nd, so that you can meet the FMI team and the Partners Group teams in person. And of course, there's always time to enjoy a glass of wine and maybe some munchies. And what I wanted to do real quick, just for the first couple of slides, is just kind of give you guys a little information about the Partners Group. We're the largest independent financial services firm here in the Northwest. We have several different locations. We've been here for about 37 years, but we're in Portland, Lake Oswego, Bellevue, Bend, Bozeman, Montana. The areas of expertise, which are on our next slide, are going to center around the 4 different areas here that you see. The Wealth Management Division, which obviously handles the investment management, asset allocation, tax strategies, estate planning, business succession. We also have a division that is our commercial insurance, which will go into, the risk management services, claims management, and so forth. We have personal insurance, which will helps with our individual clients on their homes and transportation and auto liability, personal risk, things of that nature. And then we also have our Employer Services Division, which handles retirement plan consulting, benefits, health and productivity, and our Healthcare Analytics Division as well. So like I said, this is not about necessarily the Partners Group. All I really want to do is give you an idea of who we are and what we do. And now what I'd like to do is have Matt take over, as his topic is what all of you are really here to learn more about. So Matt, you're on.
All right. Well, thank you, Geneva, and thank you to the Partners Group for having me today. And good morning to everybody out in the beautiful Northwest. It's afternoon where I'm at. I'm in the Midwest. I actually live in St. Louis. Just moved to St. Louis from Chicago, where I spent the majority of my career. And so, welcome today. We're going to talk about equity transfer. We're also going to touch on the valuation market right now and how it's affecting the M&A world. And it's important to talk about that because when we're talking about equity transfer, we want to make sure that everybody understands all of their options when exiting their business or looking at succession planning. So we'll touch on all those topics today, and hopefully after you'll have a better understanding of your options and the current marketplace and how it's very specific to the construction industry. So, to Geneva's introduction of me, I have spent the majority of my career working with privately held and family-owned businesses, helping them transfer their ownership, whether that's through mergers and acquisitions, internal types of management buyouts, and ESOPs. You can see FMI, for those that are not familiar with FMI. We are the largest management consulting investment bank to the construction industry. We call it the built environment, but it's really all these ancillary vertical industries surrounding the construction industry. And we really break ourselves up into two groups. We have our investment banking group, which I'm a part of, and then we have our management consulting group, which Ed Rowell is a part of, who will be speaking with you on section 2 and 3 of these webinar series. Our investment banking side, we're primarily doing sell-side mergers and acquisitions and ESOP advisory, but a large part of our practice also is financial advisory and what we call equity transfer management. And so we're helping business owners in the construction industry transfer their equity via other means than ESOPs and sell-side mergers and acquisitions. We're going to spend a good time talking about those options today and why they're unique to the construction industry. So when I talk about the built environment, you can see the industries that FMI focuses on. We have about 40 bankers, and we do separate ourselves, by verticals. And really, when you think about it, it's contractors, it's building products, construction materials. We have an energy services practice as well as an oil and gas infrastructure practice. And so we really look at serving our clients around that built environment. So great history. We've been around for 65 plus years, 100% dedicated to this industry. All right, so enough of the commercial on FMI. Let's get right into why you guys are here today, and that's to discuss equity ownership. So we are currently in a great marketplace, and I'm going to spend the next couple slides talking about the current macro marketplace. All right, so this includes all industries. Really, let's exclude construction-related companies when we're talking about the macro environment. It's important to break the two out because, unfortunately, they're completely opposite when it comes to valuation and mergers and acquisitions. So, we're currently in the 9th year of a bull market in the industry, and what that's saying is, are we going to continue to be able to move forward into a 10th year of a bull market, right? And we've got rising interest rates. There's currently trade and tariff discussions going on. And, how long will this bull market continue? We've seen the stock market drop around 10% over the last couple of weeks. And so there's some significant headwinds that are going into the next few years, although we believe that we've got some runway left in this bull market. The M&A market and valuations in general are at historical highs. There's really kind of this perfect storm that gives rationale to that. First of all, there's a huge supply demand imbalance between willing buyers and willing sellers right now in the marketplace. If you think about, mergers and acquisition activity has been fairly flat over the last 10 years. I mean, it's been growing a little bit. We've had some swings up and down depending on what year, on the amount of deals being done. But the amount of capital out on the marketplace right now is at record highs. You've got strategic companies, you think about the big companies in your industry, the big public companies, they're sitting on records amount of cash. And then you've got this group called private equity who has gone out and raised over $1 trillion of what we call dry powder, which is really just money to be put towards acquisitions and growth. And so we've had this incredible increase in the amount of capital to go out and buy companies, but the supply of companies, the amount of sellers has been pretty flat. So like with anything, when you have a supply demand imbalance, it raises valuations, and that's what we're seeing in the M&A market. We also have historically low interest rates, and low interest rates always increase the price of assets. And so, whether it's real estate or whether it's companies, you're seeing an increase in asset prices due to those historically low interest rates. Now, those are increasing, and it will be interesting to see, what happens to the value of those assets. With rising interest rates, we really do need higher inflation, and we need higher growth to make up for those higher interest rates. And so that's a thing that I know the Federal Reserve is looking at on a daily basis, and we'll just see how it all plays out. But we've been living in this historically low interest rate for a long time. I think a lot of people have forgot how to operate or what it's like to be in an environment that's got higher interest rates. And then the last thing is the positive impact from the tax law. The tax law really provided a lot of additional cash flow for businesses, and that cash flow equates to higher value, and so you're seeing an increased value there. So overall, just a perfect storm right now for valuation and M&A activity. So this graph should give you a good indication of the current marketplace today. You see that the public contractor average TEV to EBITDA. TEV really stands for enterprise value, total enterprise value. Just think of enterprise value as the value of your company, okay? So, the value of your business as a whole is the enterprise value of your company. And if you divide that by EBITDA, which is earnings before interest, tax, depreciation, and amortization, bankers and people in the deal world use it as a proxy for cash flow. And so when you take those multiples, it's a good way to see, how much are people paying for businesses versus what their cash flow is producing. And right now in the public marketplace, you're seeing multiples really not seen since 2008. And so, I think there's it's a combination of the previous slide, which, the low interest rates and supply demand imbalance. But the other thing is just because we've had low interest rates, a lot of people have been flocking to equities. And when they do that, it increases those share prices because a lot of people are really uncertain right now to where to put their wealth and capital, given the low interest rates you're getting in your savings. And so a lot of people are kind of flocking to the equity markets. So we'll see how that changes as we, are able to get a little bit more money in interest out of your savings with fixed income. So the challenge that we have in the construction industry, next slide, please. The challenge that we have in the construction industry is, remember, we were talking about the macro market on the previous slides. Now we're going to talk about the M&A market, okay, with construction. They are completely different, and the reason for that is because construction adds these variables that other industries don't have to deal with, right? We've got bonding requirements in construction, that increases risk. And when that increases risk, and it's also a drain on the capital that you can utilize, it hampers financing and it hampers the ability to go out and finance. It's highly dependent on people. The construction industry is very people driven. And, other than other industries where, maybe you can have machinery and equipment, the construction industry is very much people driven. You can only scale as much as you can find good people to help win new jobs. And so it's tough to scale construction industries, which is the bullet of absence of economies of scale. It's highly cyclical, which means, we're very much driven by the economy. And so those items, the cyclicality and really the bonding, almost exclusively excludes private equity firms investing in construction M&A. Now, that doesn't mean they don't. There are some private equity groups out there that we sell to, and we do work with them, but it typically is very specific, and we'll get into that later on in the presentation about what type of companies that private equity is looking at. But they're very specific in the type of contractors or construction-related companies that they're interested in. So what that does is when you take away private equity from the construction M&A market, it takes away that supply-demand imbalance that we've seen in the macro M&A market, because we just took away the largest buyer in the entire country, which is private equity. We took $1 trillion worth of capital that could be deployed to buying contractors, and we've taken that away. And so that, as long as it's a highly cyclical and the risk, lowers multiples. And when it lowers multiples, that means it lowers valuation. And so the reason we're talking about this is because, construction M&A is a tough market. It's a tough industry, and we do the most construction M&A deals in the entire country. But most investment banks will have many different types of verticals, food and beverage, equipment, distribution, manufacturing. Not many of them have construction or engineering practices. And that's just because there's a limited amount of buyers and a limited amount of deals that go on every year. All right, and it's important to know that when you're thinking about your options, what are your options as a contractor? Is there a third-party market? So the drivers of M&A activity, what drives buyers? If you look at some of the big M&A deals that have taken place over the last couple of years, there's been very specific reasons. If you look at the diversifying geographic risk, the reason MCOR acquired CCI, right? So they want to diversify that geographic risk. If you're in one market and you want to enter into another, if you look at the last bullet on what drives buyers, the ongoing dilemma: do you acquire or do you greenfield? And greenfield means, do you just go into a new market with a project manager and start up a construction company, right? That's one way of doing it. And it's by far the most popular way of doing it. That's what most contractors do to enter a new market. Another way to do it is to acquire somebody that's been there for a long time, has the reputation, the people, the processes, the backlog, and go in there and acquire them. So we see a lot of M&A activity around diversifying the geographic risk. Do you want to diversify your capabilities? One of the reasons that Jacobs acquired CH2M. It's a good way to start up a new practice in your firm without going and starting it from scratch. Acquire people. That's a big one today, especially, we are in a great economic environment. I mean, record low unemployment rates. And so I have a feeling most people, especially in your guys' markets, which are really, really great markets, finding good qualified people is difficult right now. And so, some of the acquisitions we see in are to acquire people, to acquire additional bandwidth. The AECOM and Shimmick deal was one of the reasons for that acquisition. Establish the local partner. We talked about that. The Cellini Lane transaction was one of the reasons they did that. And so that's really what drives buyers. But what drives sellers, right? And we have all these bullet points, but the most important 2 to 3 that I see in my career is retirement succession. Most business owners do not decide to start thinking about selling until they're ready to sell. Very few say today, try to time the market and time the price. It happens if you get an unsolicited offer from a buyer and you decide you want to, test the market, that could be a rationale. But the majority of clients that I've worked with in my career is because of retirement and they're ready for success. They want to start doing succession planning. Unfortunately, actually few there's out there do it in a calculated manner. The statistics, and these are rough statistics, but 20-30% of all contractors liquidate their business And that's a high number compared to other industries. And then the reason they do that is they had never planned for succession. They hit 75, 80 years old and decide they're ready to sell their business. And then FMI comes in and tells them, well, I'm sorry, you're not saleable. You don't have a saleable business. And so we're going to have to do an internal transfer. And you'll find out later in this presentation how long those internal transfers take. And what that creates is it's a personal risk. Does the seller at 75, 80 decide to try to wind down his business over the next 10 to 12 years, or try to liquidate and get rid of the business? And so, unfortunately, we see too many people wait till too long to start worrying about succession. Succession planning, if you're not selling to a third party, is a 10-year process from start to finish usually, and it can be longer than that. And so if you're 60 today and you want to be out by 70, well, then the timing is right to start worrying about that succession plan and how you want to implement that. It's a long process if you're not selling to a third party. So the key takeaways that we've talked about, 80 to 90% of contractors are unsellable to third parties. That number, 80, is probably low. I mean, it's probably closer to the 90% of contractors. We do a lot of we sell a lot of specialty trade business service type contractors, but a general contractor, heavy civil, regional contractors are tough because there's just not a lot of buyers out there. And so then 90% of contractors are unsaleable. That's a real number. And so if you think about that, we have to provide other options for contractors to exit their business. And that's what we're here to talk about today, as well as, always the third party is an option if you have certain attributes that make you saleable. Some of those are, strength of management team. And that's really it's really kind of a catch-all saying, because the reality is you can't really exit your business if you don't have the strength of management team. So Ed will talk about that in the next couple of webinars, and how our Center for Strategic Leadership works with companies all over the country on building their management team. Because you can't sell your company to a third party without a strong management team. And you definitely can't do it internally, because you have to have somebody that can run the business that you're going to transfer that business to. And so building up that strength and that bench is so important, regardless of what type of exit option you're looking at. Other companies that we're really seeing that are getting a lot of attraction right now are companies that have a degree of self-performance, service, recurring revenue. Those are really, if you're a mechanical, electrical contractor and you have a large component that's service-based, recurring, that all of a sudden brings in private equity into the transaction. And so anytime you can have less risk in your earnings, in your revenue, given the recurring revenue component, that's going to attract other buyers. All right. End markets are very important. If you're doing electrical work in the solar industry and healthcare, or if your end markets are growing, those are going to be more attractive than maybe being in some end markets that are projected to be flat to negative over the next 5 to 10 years. Size and geographic diversity are also important. If you look at cities like Nashville, Denver, Seattle, Portland, areas like that, I mean, those are very fast-growing markets, and there's going to be more interest if you're a contractor in those markets than maybe say somewhere like Topeka, Kansas. It's just buyers want to go where the markets are, where the growth is, and they also want to ensure that those end markets, are there. And also the level of bonding. If you're doing less bonding work, you may be able to attract some new buyers, because typically private equity won't want to get involved if the majority of your work is being bonded. So these are high level, but from our experience, these are the attributes that make contractors saleable versus non-saleable. And so we'll talk about internal transactions, and those often can be great options as well if you're not one of those companies. So FMI does a OTMS survey every 4 years, and OTMS stands for Ownership Transfer Management Succession. And it's basically, the investment banking team on the ownership transfer and our leadership and consulting team get together on the management succession, and we look at how do we transfer companies ownership and equity, and that's through financial means, but also through management. And so we do this survey every 4 years, and in the latest survey, and you can see the gray on the left is 2017, and the orange or yellow is 2013. Okay. Some of the key takeaways that we saw in the latest OTMS survey that surprised us a little bit were that fewer respondents are planning to pass the business on to the next generation. You can see in 2013, 52% said they would. In 2017, that number has dropped down to 32%. It's a trend that we're seeing in almost across the board, is that the kind of hierarchy-based nature of contractors is going away, and they're getting more into more broader-based ownership, whether that's a broad-based management team or through ESOPs, which you can see right below it. In 2013, only 4% of our clients said they were going to do ESOPs, and now 12%. And so that's a big jump, and we expect that number to continue to increase as we're getting calls a lot around ESOPs and are they right for for certain contractors. Fewer firms are also wanting to sell to a third party today than in 2013, and that's dropped from 17% down to 8%. So about 2/3 of all contractors transition their business internally, which is a pretty high number compared to other industries. But we'll hammer this home again and again. It's because a lot of contractors are not sellable to third parties, and so we have to come up with other alternatives for those business owners and those contractors to make sure that they have a succession plan put in place. The primary methods of internal transfer. So if you look at these 4 boxes, we talked about the direct sale M&A. It's an obvious choice for transferring your business, and that's an external transfer. The internal transfers that we're looking at, and we're going to talk about all these today, is we have the Subchapter S and LLC buyout, and we'll explain those in greater detail. Sale for a note. We also have an OldCo, NewCo structure, and then we have an employee stock ownership plan. All of these methods are different ways of moving ownership with different outcomes and different tax ramifications, but they're all options, and there are different pros and cons to each, and for certain companies may make sense for some and not so much for others. And so we're going to go through some of those today with some high level type of pros and cons to each one. These next few slides, and I'm going to go through these fairly quickly because it's really just rehashing what we showed on earlier slides. But you can see that the definitive ownership transfer plans per the survey that we sent out has around 43% selling to their employees, and only a very small few are planning to sell to a third party. That 4% liquidate, of course, I love to see that because that just shows that more people are doing succession planning. We'll see if that number, that 20 to 30% of all contractors liquidate, we'll see if that number comes down over time as more and more contractors are getting educated on what those options are for them and to start planning sooner. So that was a good sign to see that in the latest survey, and we hope to continue to see that progress. Most contractors want to sell their company over a period of time, about 40%. And, and that's really, unless you're selling to a third party, the only way to sell it is gradually. And so That number probably should be higher, but I think when you look at the specifics of the question, it's a pretty good number from a rationale perspective. 11% through OldCo, NewCo, and then we talked about the selling to an ESOP at 12%. So that number has increased, and we are going to spend a couple slides on ESOPs. Although we could spend a great amount of time talking about ESOPs because they are fairly complicated transitions. So who will ultimately own the company? If you see that gray area, it says only 7% will one individual own all of the company's stock. Back in the day, that number would have been much higher. But as I said, we've seen a tremendous shift in ownership transfer over the last 5 to 10 years, from kind of a one owner, executive to broad-based ownership. And that's just because you're seeing a lot of family-owned businesses. Maybe a single person started the business and they passed it down, or maybe that single owner still owns it today. And what are they going to do with that ownership going forward? Most sellers want to have more people with stakes in the company. You see that multiple owners, but one shareholder with control at 51%, and multiple owners with no control at 42%. So you're seeing a huge trend, whether it's with control or without control, of owners wanting to pass down their businesses or transfer their businesses using multiple owners over time. These are some of the most common reasons for ownership transfer plans not working. I will say that we've got a lot on here, but the ones that we run up to most are the one you see in the top left in navy blue. It's around 31%, no competent successor management. And so that is why companies will liquidate, is because they don't have that management team put in place to take over the business, or they don't believe that they're going to be able to transfer that to that management team for a sustainable company going forward. And so that is by far and away the most important piece that we see and why transfer plans don't work. And it's something that needs addressed in our industry, and we are addressing it. But you have to have a competent management team regardless of what type of internal transfer you want to do going forward. All right. So now we're going to get into the methods of internal transfer. And we're going to walk through each one of these. So let's go ahead and go right into the next slide. So some key facts and assumptions about ownership transfers. So first of all, the time frame is around 8 to 12 years, right? And some of them will be less and some of them will be more depending on how they're structured. But we talked about that 10-year time frame from the beginning of succession planning until you're fully exited. That 8 to 12 years is a pretty appropriate number, regardless of the transition you're looking at. Depending, if you sell to a third party, you'll probably be out in 2 to 3 years, given your employment agreement and earn out. That'll probably be negotiated as part of the transaction. An ESOP could probably be on the lower end of that, if not a little bit less. But the other transfers are really going to be in that 8 to 12 year period. We have a saying at our OTMS. It's called buying yourself out with your own money, and unfortunately, that's the truth. You are going to majority of the time transfer your ownership with your own money. Now, we'll talk about in the methods of how we'd like to see, if you're going to give ownership to key employees, that maybe they put some skin in the game. But the reality is that's going to be very minimal compared to the total value of your business. And so, it's transferring your business is very much, it's a risk mitigation strategy for the sellers and succession plan, but you will be buying yourself out with your own money over time. So, and the people side is the hardest. Who do you give ownership to? Do you have that in place today, or do you have people that you want to integrate over time? the transition plan you decide on is very much going to be dictated, by where you're at in that process. And we'll go through which ones are more appropriate, given which side you're on right now. Most plans don't work because of poor communication, inadequate profits, and the wrong people. Sometimes you'll put a plan together and you think you have that, 1 to 2 or 3 group of people that you want to give the business to, and they just are not working out. If the plan is structured, incorrectly or not appropriately, you could be stuck with those wrong people and not be able to make changes over time. And so we see a lot of plans that don't work because of that. And poor communication. You want to make sure you're very transparent with your management team and the new executives of what your plan is. Do they want to be a part of it, and how this is going to play out over time. So the first method that we're going to discuss today is a sale for a note. And this is a very simple concept. We call it a seller note. All right. You're basically, as the owner, selling your business to a management. It can be an individual or a group for a note, right? So this will require a company valuation because you are taking in a note, so you are giving away upside in your business in equity. And we'll talk about some of the other equity transfer plans and what we want to utilize for evaluation, whether it's book value or a third-party valuation. For a sale for a note, we definitely want to use a third-party valuation. You want to get full value for your business because you are giving away some control and any equity return in the future. The employees will buy as much stock as possible. Now, I will tell you, in over 50% of all of our internal transfers, the management team will not put up any money because they don't have it or they don't want to put the risk. And sometimes that rubs owners the wrong way, but it's a reality of kind of where we're at from a mindset perspective, especially with the younger generation who's a little bit more risk averse and maybe doesn't want to put their money into a privately held business. And so, or people just don't have that kind of capital to put into a business. And so we would like the employees to buy as much stock as possible, skin in the game, but sometimes it's not feasible. The owner will then sell their stock to the key employees in exchange for a note, and those current owners will keep that stock as collateral. We typically like this to be kind of an off-balance sheet type negotiation or agreement, because if you do a seller note on your balance sheet, there will be implications with the surety and other pre-qualification and things like that. So this typically is kind of just an agreement in principle. Well, not in principle. There are operating agreements and things like that that go into place, but the current owners will keep that stock as collateral until they are paid back. So obviously, some of the drawbacks for the owners is that you're not going to be able to participate in the future profitability. You are selling your company. And so this is used when business owners are kind of ready to get out of the business today. Maybe they have 1 to 2 years left. They already have the next management team or individuals they know, or they're already running the business today. And this is just a clean, simple way to exit the business. And so because this is very tax inefficient, this usually, at appropriate valuation is a 7 to 10 year buyout. So obviously with a lower valuation, you can increase that, or you can lower that number of years. With a higher valuation, you can increase it. And the interest rate on that note will also determine how many years that will take. The next 2 buyouts I'm going to talk about are the Subchapter S and the LLC. These are 2 very similar type buyouts. They've got a few nuances that distinguish them. We're going to go through them both, but I think when we look at these buyouts, it's important to think about these kind of as connected. So let's start with the Subchapter S, then we'll get into the LLC, and then talk about some of the differences. All right, so Subchapter S buyout, which most of our clients are Subchapter S corporations, which means they're passed through entities. This is the most widely used form of internal transfer, at least it was prior to the new tax bill. So you're basically just distributing excess capital to owners. And the employees are going to buy as much stock as feasible. You're going to hear that throughout. And then you're going to annually distribute the profits as compensation or sub-S dividends. The employees are going to reinvest those dividends or some portion of a kind of a ownership bonus to purchase stock each year. So, you give an employee a $100,000 bonus, that employee pays taxes and then turns around and buys your shares, right? Very tax inefficient because they're paying the highest ordinary income on those, on that bonus. But that is typically a way to get more ownership in people's hands in a sub-S. The majority owner will receive cash from the sale of stock and his or her relative share of sub-S distributions. So one of the issues that we have with this is that, the sub-S distributions are fairly inflexible in terms of how those sub-S distributions are factored in on an annual basis. If you start giving ownership to one owner in year one, they're going to be required to get a pro rata distribution. I'm sorry, next slide. Pro rata distribution every year, regardless. Let's say in year 2 or 3, you decide that owner isn't working out. They're still going to get their pro rata distribution. And so any excess distributions you make to help with other people buying out your stock, that one owner is going to continue to benefit based off of that system. And so it's a little inflexible there, but it is very widely used. And majority of the time, if you want to expedite it, you give larger bonuses, which will allow you to get other people ownership early. This takes every bit of 10 to 12 years, and you're really not valuing your business from a value perspective. What's really important is, as an owner, is how much money do you want over the next 7 to 12 years before you decide to really pass on all of the ownership. And we can model out different scenarios to show, what those different years are, how many years it takes for each scenario. But instead of valuation, it's really more about how much money, compensation, and the type of ownership the seller wants to provide over time. So, typically these are book value type transactions to help expedite. And when I say book value, it's really adjusted book value, because what you really want to do is you want to distribute any excess cash or non-operating assets prior to the sale to get that off of your balance sheet to allow for a more stream, an easier transition over time. So if you have built-in gains, or if you have like AAA accounts, you have real estate, things like that could just slow down a sale of transfer. We want to figure out a way to, distribute that, or figure out a way to get those off of the balance sheet as we transition the ownership. An LLC buyout, very, very similar to what we just discussed. An LLC is a pass-through, similar to an S corporation. The biggest differences here is that an LLC just provides more flexibility. That same issue we talked about with the pro rata distribution. An LLC is more flexible in how you can include or exclude people throughout the process. It's much easier to add new buyers throughout the buyout process in an LLC than it is an S corporation distribution. There's also some tax advantages to an LLC buyout. Now, before we get there, it's it's not as simple as just saying convert from an S corporation to an LLC or from a C corporation to an S corporation. There are tax consequences depending on how they're structured, right? So if you go from a C corporation to an S corporation, you're going to have some built-in gains, and there's some other tax provisions in there. To go from an S corporation to an LLC, there's going to be tax consequences because you're really terminating and liquidating your S corporation, and you're going to owe taxes. Now, there are strategies around that. They're, complicated strategies where you can, set up kind of LLCs or other types of entities, within those structures to avoid that. And we are doing a lot of those now. But I think it's important to understand that, you have to get people involved, tax people, financial professionals that can help you through that process because there are tax implications. But we have found LLCs have been a very good tool for, for these type of buyouts because there's some tax advantages to it. One of them is, the qualified business income deduction that business owners are getting today with the new tax bill, that's lowered an S corporation or an LLC's tax rate, federal tax rate, from around 39% to 29.6%. And if you compare that with the top individual tax rate of around 37%, there's a more than 7% delta there between tax rates. So if you think about that S corporation option that we were talking about, you're going to bonus to individuals, and then they're going to pay that highest tax rate, 37%, and then buy your stock out. In an LLC, because it's more flexible, you don't have to do the bonus. And so you can use all after tax, after your qualified business income to distribute cash. And so there's a pretty significant decrease in tax rate there. The downside is that LLCs, you're taxed on distributions for FICA. And so there is a little delta there as well. And so we just have to, work through those and figure out which one, from a tax perspective works better, as well as, from a flexibility perspective. So this is usually the hardest, other than ESOP, the hardest transition option that for business owners to contemplate, just because it's not a normal, it's not a natural kind of transition. You're actually having to set up new entities, and and it's a little different way of operating the business than they have in the past. So what I'm talking about here is what we call an OldCo NewCo strategy, and basically this is a way of transferring an existing company to a single party or a management team, and it's usually a management team. This bypasses the difficulty of more of kind of an outright purchase or sale. So how does this work? Well, first of all, the existing business is going to remain under the original owner's ownership and control, and that's OldCo. The new management team is going to form a new company called NewCo, and that they will manage the future operation. The OldCo will contribute certain assets, working capital, WIP, equipment, things like that, to the new owners. The OldCo will continue to support NewCo, and NewCo will benefit from OldCo's resume, bonding experience, you name it, right? And the goal there is for NewCo to start building up their own equity, to start building up their own processes and systems. And then when NewCo is relative, or when NewCo can function independently, that's when that joint venture will eventually terminate, okay? And so this is a good way if you have a management team, a group of 3-5 people that today are your next owners, right? Because this is very difficult to add new owners in over time. So this is ideal when NewCo relative ownership is relatively certain. If you don't have that certainty, an OldCo NewCo may not be the best transition strategy for your company. Some of the pros and cons to this are there is no actual sale of stock, okay? You are just transferring assets, and you are, you are getting future profits of the company as a seller until that kind of agreed upon profit stream or the company can operate as a standalone. So that joint venture is typically terminated when NewCo can stand alone or by the total earnings that's determined in advance. And so there are a lot of things that you can do to put in here to get the money out of the business, as well as it really allows for a separate and distinct management of the capital, the profit and loss, the employees. You're really starting a new business and allowing that new management team to run the company. All right. And lastly, I'm just going to spend a few minutes on ESOPs, and we can then wrap this up. ESOPs, like I said, we could talk about this for hours, and they're a fairly complicated transition, but a growing transition strategy for many contractors. You can see that ESOPs are in almost every industry. Construction and engineering are one of the largest industries. And you have some very large contractors who, have gone this route. So public and private companies, and they're really in almost every geography around the country. And so majority of ESOPs are, really around that 50 employees. I'd say 50 employees to 1,000 employees. And for contractors, it's, you got to have at least, I would say, 30 to 50 non-union employees to make an ESOP work. Because the union, because it's already collectively bargained, is typically excluded from the ESOP. And so you have to have enough qualified payroll to make an ESOP work. The National Center for Employee Ownership, which is the NCEO, which is it's a nonprofit group in the ESOP industry, came up with some statistics, and those statistics were pretty staggering in comparing ESOPs to non-ESOP companies. ESOP companies are 25% more likely to stay in business. They're 4 times less likely to be laid off during a recession. They have 2.5 times greater retirement accounts than non-ESOP companies. The employees receive more in wages, and they have higher job growth. And so they did this study. I don't remember how many years that they did the study over. There's a significant amount of years comparing ESOP-owned companies versus non-ESOP. And the results were pretty staggering. And that's just because ESOP companies, typically will have more of that employee ownership culture, accountability, transparency versus their non-ESOP peers. I only have a few minutes left, and so I'm going to just very high level talk about what an ESOP is. So an ESOP is really one of 3 things. It's a liquidity tool. That's what we're here talking about today. It's just another option for business owners to transfer their business. It has significant tax advantages. For the company, 100% S corporation ESOP pays no taxes, no federal, and in most cases, no state taxes. So if you're making $1 million in pre-tax income, that $1 million will go right back onto the balance sheet. Okay, there's no need for taxes if you're, and there's no reason for a distribution because the owner is the trust. The trust is now the owner of the stock. Okay, and trusts do not need a distribution for tax purposes. And so 100% S corporation ESOPs, there are thousands of, pay no federal or state income taxes. And so it's a huge competitive advantage for those ESOP companies. For the sellers, under certain provisions, can defer their capital gains. So if you sell your business for, say, $20 million, you could defer any taxes on that sale. Like I said, it's more complicated than that, and we don't have time to get into that. But you could defer that capital gain, and under the appropriate structure, if you hold it through your lifetime, you could pass that gain down. You could pass that investment down to your heirs on a stepped-up basis and never pay taxes. So on the seller's side, they could defer and potentially eliminate taxes. And then on the company side, the company can eliminate taxes going forward as well. So significant tax advantages. And it's also a qualified retirement plan. It is regulated by the Department of Labor, and it is a program under ERISA, similar to 401k. Some of the cons, and I'm just going to, there's a lot of pros to doing ESOP. Some of the cons compared to other transfers, it is regulated by the Department of Labor, and they do take a hard look at some of these transactions. These ESOP transactions are getting more complicated and more structured, and they are more formalized. And I think the ESOP world has come a long way over the last 10 years. And I think it's partly due to the Department of Labor kind of coming down on some of these transactions. There will be a need for more formalized corporate governance. That's if you go 100% ESOP. I think it's important to say that you don't have to go from 0 to 100. You could take some chips off the table and start with a 30% ESOP and then transition your ownership over time. And there are ongoing administrative costs. The company will have to be valued every year by a third-party valuation firm because there is an obligation for the company to require a market for the employee stock. It can be a great retention and recruiting tool, as I've shown you the statistics on ESOP versus non-ESOP companies, and it can provide meaningful benefit to the sellers. And so it's a growing option and one we could spend a lot of time on, but just running out of time today, so that's all I'm going to have on ESOPs today. So that is the end of my presentation, and just want to thank everybody for their time, and feel free to reach out to me directly or through the partners group if you have any additional questions on today's presentation.
Sounds good. Thank you, Matt. We really appreciate such a valuable topic, and I know that it's on a lot of contractors' minds here in the Portland metro area, and I'm sure in other areas as well. You will get, all of those of you that are on, you'll get a reminder regarding the part 2 of our series. It's next Wednesday at 10 a.m. as well, Pacific Standard Time. The topic that day will be succession management, where Ed Rowell will be our presenter for that one, and we'll share some very valuable information with you guys as well. As I mentioned earlier, you will get a form at the end of this to fill out, submit any questions that you may have, further information that you want to learn more about or whatever, and we'll make sure that you get those answered. We'll also be sending a copy of the webinar itself to all those that attended and those that in some cases were not able to attend as well. So thank you, everyone. Have a great day.